we've gotten a lot of bad ideas, people over promising, and that has burned a lot of people. So that's really important to keep in mind that there is more bad models than good models. So that's the first thing.
Just looking at the pattern there, you could clearly see, okay, Bitcoin is following this like kind of adoption pattern related to, this power curve growth.
You can never predict the future in the sense that you will pinpoint what's happening. And even if somebody tells me like 2 months later, this would be the price, and exactly that price happens, I'm like, this is just by chance. It's impossible that anyone could do it.
When are you expecting more or less the bull market to top? And how high do you think Bitcoin is going to go? Guys, welcome back to another show today. I'm here with two amazing guests. We have Sina, co-founder of 21 First Capital. How are you doing, man?
Very good. Thank you very much. Excited for the chat today.
Likewise, welcome back to the channel. Guys, if you remember, Sina has been on the show before. I will link in the description, of course, the previous conversation. And we have Plan C, which is a Bitcoin researcher and co-founder of the Quantile Bitcoin Model. How are you doing, man?
Yeah, doing really well. Thanks for having me on the show. Pleasure to be here. And yeah, looking forward to the chat with you guys. Always love talking about Bitcoin and seeing, what we can discover.
Is it possible to predict the Bitcoin price with math?
Wow. You started with the hardest one. Okay, let's see. So the first thing is we've gotten a lot of bad ideas, people over promising, and that has burned a lot of people. So that's really important to keep in mind that there is more bad models than good models. So that's the first thing. But prediction is a tough word. You can never predict the future in the sense that you will pinpoint what's happening. And even if somebody tells me like 2 months later, this would be the price, and exactly that price happens, I'm like, this is just by chance. It's impossible that anyone could do it, right? However, there are patterns that we can identify. And if those patterns are very stable, very strong, and they have a logical foundation behind them, you can put some boundaries around what's possible, right? And if that's the case, then you can have some partial visibility into the future, more in terms of probabilities and likelihood rather than certain outcomes. So that is possible. If you have a really good model and if you have a really good understanding of what is driving the flows, what is governing where money goes, you can have some predictability, and that's how everyone in finance with an alpha edge is making money. They make probabilistic bets that are more right than wrong, and that is possible. But a lot of people that are like super successful in understanding the future path, they also would be the first to admit, we also make a lot of mistakes along the way. But the thing is, the model has a strength. So over time, you make a few mistakes and you make a lot of right calls, and over time it balances out to be very successful.
So what do you think, Plan C?
Yeah, I definitely agree with what Sina said there. I would say, definitely with Bitcoin, longer term, there's some patterns that seem a lot more clear. Short term, anything can happen. The short term, you can create models around short term or even midterm. Those are a lot more challenging. Longer term, finding, like you said, bands of probability of where Bitcoin will be. There are bands you can look at where you can say, okay, what's the probability of Bitcoin being at $1 million this year? You can really look at that and say, well, that would break, every pattern, that's ever existed for Bitcoin. Now, could it happen? Of course, there's a probability for it. Would that mean that the US dollar as a denominator would probably have to break? That would be my thesis. So you have to look at it in different theses and say, okay, if the US dollar remains a stable denominator, then based on the patterns we've seen throughout history, and you also have to look at, this is where theses come. It's the math, but it's also like, okay, what's my thesis here? Because with Bitcoin, it's a network, it's a financial network. There's an adoption element where you're seeing a market cap grow. You're seeing the order books becoming more thick. Over time, you're seeing a clear trend of diminishing volatility. So when you see those patterns and you see this kind of decay with how extreme the deviations of the peaks are, you can start to say, okay, there's a clearer trend here. Now, could that trend break? Of course. And you have to look at those what would cause it to break, and then you have to basically monitor the early signals of that potential breaking up that pattern. So you basically have a core thesis around what the data shows, surrounded with basically logic around like what you're actually modeling, and then you also are monitoring, the things that go against your thesis to get early signals where there's some sort of like a phase shift in the model. So that's kind of how my approach. But yeah, to say okay, Bitcoin's going to be 250 or 284, or 444 or whatever on a certain day is, if you get it right, you're just lucky, right? So, but yeah, we can model to a degree. In my opinion, long term, we can create some really good models around Bitcoin. Yeah, and like Sina said, there's been a lot of models that haven't worked or have burnt people, and so people are probably a little turned off of models. But I mean, in my opinion, they still have a ton of value if you find one that has some solid backing to it.
And the data is not a lot, like it's a teenager, right? So it's going to become easier maybe for future years to predict based on past performances.
One thing I would say to that though is Bitcoin's it trades 24/7. So even though it's only been around for 13 to 15 years, if you actually look at the amount of hours that Bitcoin has traded, it's actually closer to the stock market. Like it's actually not as much of a deviation as people think. So that, yeah, like I said, because it does trade 24/7. As far as the time it's traded, I do agree with you. It's still really, really nascent. But I mean, as far as trading hours, it's a lot older than it might appear. It's a wise teenager with a lot of life experience, you could say.
That's a good point. I actually never thought about it, but it makes a lot of sense. What do you think, Sina? What would be a good time frame to have a quote unquote solid math behind it?
If you're modeling something that has many, many years of data, but then you can't put a clean model on it, and every decade it moves slightly differently, that kind of calls into question everything. Interestingly, with Bitcoin, what we are seeing is something I've never seen in any other data set. I've been analyzing business and finance data for, say, 15 years. And this is really the first time I'm seeing such a clean rule that applies to the data. I mean, for whatever reason, Bitcoin just follows this pattern for a very, very long time. We could probably go back to 2013 and build the same model that would get us to more or less similar prices to here. I've tried this a few times. Like if you build a similar model to our Quantile model in 2017, it would have a very similar prediction to today, maybe with 10,000 error. So this is like, I would have, if I hadn't seen it, I would have said this is impossible. But I've seen it, I've tested it, I've spent, many, many months stress testing this Bitcoin's behavior and pattern. This is strong, and it's really not a function of the duration, because again, 20 years ago, 15 years ago, the world was completely different. But the idea that your model keeps very reliably matching the data, that's what I'm looking for. So I'm looking for the amount of error that the model causes, and especially out of sample, right? So imagine we go back to COVID periods and we have the same formula, and if years later it's still valid, that tells me that you're actually capturing the real dynamics in the data, as opposed to overfitting, because once you know all the past data, you can always come up with a model that perfectly explains the data, but only for the data that happened in the past. When it comes to future data, it may not do anything. And that's one of the best ways to trick your audience, when you really don't know what you're doing, you can come up with a fantastic model of the past, which is useless for future. So that's why whenever we're looking at models, it's very important to see how it does on new data. Or if you don't have the luxury of waiting for several years to see how it does, you can go back and don't use the recent data for modeling. Build your model and then test it on the recent data. And we've done both, basically. Last year when we were developing our basic models, price was going down and away from the model. It has come back to it for the last year. Essentially, Bitcoin has been hovering around the average that comes from the model. So we have that, but we also, if we can go back 7, 8 years, the same model works today, and that's amazing. I would naturally avoid predicting something 5 years into the future because so many things can happen. But this is so tight, we can more confidently say that the pattern that has been there for 15 years, these long-term trends don't change overnight.
I agree. By the way, backtesting data, it's a fantastic way to make sure the model is on track. And are you kind of considering the Fourier cycles, or do you think we're going to break out of them?
But that's a great question. One of the things we have, Plan C and I have agreed on when we were developing the Quantile model was that we don't want to be putting too much weight on our ability to predict cycles. Why? Because, so essentially, a model is agnostic to cycles. Cycles may not exactly happen like before. The reason for that is the relevance of halving is going down. Well, of course, the supply shock that comes from halving is getting exponentially less important. And one day of ETF action could nullify everything that is happening on the block reward after the halving. So, mechanically, it's not important. However, psychologically, it is still important. And the cycles actually might repeat to some extent, definitely smaller. And we actually do observe in our data that the volatility of Bitcoin is going down. So you're not going to see those massive 100x gains. Sorry, guys. I know this is a painful message, but you're also not going to see the 90% crashes on the positive side. And that's actually what exactly we expect from a global reliable asset class that everyone in the world puts money in, all the institutions and everyone. You can't expect that with an asset that crashes 90%, and that's not going to happen. So when more people join, there's more liquidity, more buyers for every seller, more sellers for every buyer. So people sell when price goes up, and that prevents crazy spikes, and also the other way. So it's actually all positive. It's de-risking the asset. So we do expect that, but at the same time, there is still retail dominance. There's still some expectation that Bitcoin should grow, and a lot of people feel positive. So the psychology will last, I think, at least this cycle. I do really expect we rhyme with the past cycles, not exactly repeat them. One nation state adopting Bitcoin causes a completely new top that's out of place. And then that changes everything with the cycles. That's totally possible.
Yeah, isn't that the Michael Saylor argument when he says when Godzilla comes in play, it destroys all the charts?
But I would say something. I mean, this is something that we would have also said maybe last year. But amazingly, Bitcoin is still, even with ETFs and Trump administration supporting it, all the Bitcoin strategic reserve, with all of that, we are kind of still following the same trajectory, just weaker in terms of the percentage gain. But we have created a new model on our platform. We will talk about that later. But since the conversation is about it, our most recent model is a cycle model, where basically it takes a pattern of past cycles and projects what's happening this cycle. And amazingly, we are on the same path. So it's kind of like logically, I don't expect cycles to go on, but what I see in the data is we still rhyming.
I ran a poll on my account, and I think it had quite a few votes. It was like over 5,000 or something at the time. And I said, "Do you still believe we'll follow a 4-year cycle?" I just want to hear, what people thought. And from what I remember, it was the majority still believe in the 4-year cycle. So to Sina's point, I definitely think that the effect is more of a psychological effect than anything. And I'm also in agreement with him about the halvenings. I don't think they're the driver of this 4-year cycle. I think it's more to do with just people believing in the 4-year cycle, and there's a certain amount of people that are just going to sell at the end of this year or early next year because they still think we're going to follow a 4-year cycle. So there'll probably be an effect from that. To say to what degree, it's hard to say. But definitely, as far as the 4 year cycle goes, I like to remain cycle length agnostic, and that's really why I love the Quantile model so much. Is it doesn't it's cycle length agnostic. I mean, it essentially says here's the distribution of probabilities, and here's the distribution of the data set historically speaking, and based on where we are, we can say, okay, I mean, we can identify we're in the same range or the same, relative to the data set, we're where we've been at all the previous, cycle peaks. Now, we can get there at the end of this year, or we can get there sometime next year or whatever. The point is where we are in the data set. And I don't look at, just to be clear, like, for example, something like the Quantile model. I don't, people can do whatever they like, of course, but I don't like to present it or think it should be presented as any kind of a trading model, because that's not what the way I look at it. I look at it as as far as its value goes. I look at it as basically a model that gives a lot of long-term conviction. So when you see something that is following this sort of a pattern long-term, you can say, okay, this gives me more conviction to hold long-term. I'm not just looking, because people, they're on social media, they're looking at headlines. There's a lot of fear even during the bull markets, right? You climb the wall of worry. There's a lot of fear. So the short-term volatility can get people thrown off. I've never been more calm. I've been in for multiple cycles, but this is the cycle I've been like completely calm, because I'm just not focused on anything short term. When you have a long-term map and you're a long-term holder and you're not trading your Bitcoin, you're just saying, I'm going to hold. And you basically have this map where you're like, okay, this pattern's maintained until I see a sign that it's not. This is the pattern. And as far as another way the Quantile model has value for me is it gives me a relative perspective on if I do want to take some lifestyle chips off the table. So at a certain point, you want to sell a portion of your Bitcoin for lifestyle reasons. Most people will sell some, right? And so you can at least say, okay, I might sell a small percentage. I'm not selling it to buy back in later necessarily. What I'm doing is I'm saying, okay, based on the Quantile model, based on where we are in the data set, I'm getting good value relative to the history of the data set. And I can confidently say, okay, if I sell some at this point, I feel like, okay, I got good value for my Bitcoin. Now, everyone just says, okay, hold forever. But I do think a big part of the reason why this cycle is playing out as far as these like long consolidation periods is I think a lot of the OGs that got in, before 2015, whatever, like a lot of these people that got in, single digit, double digit, triple digit Bitcoin, they've hit their lifestyle, like they're taking lifestyle chips off the table. This cycle, these moves we've had, it's hit certain levels. Everyone has their level, and it's hit certain levels this cycle. That's why over a year ago, my thesis for this cycle was, as opposed to 2017, we had, I think it was like 12 of these really sharp and then quick rebound. This cycle, my thesis was long consolidation period. So we wouldn't go down as much, but we would consolidate for a long time, build a base, and then move up. And that's what we've done twice now. We've had these like a long consolidation period. This is the second one we're basically just coming out of right now, I think. But multiple months of sideways kind of action, even sideways to slightly down action, as a lot of old OGs basically dump some of their Bitcoins. And once we've kind of completely washed out all that sell pressure, the thing we have though is we have a lot of demand coming in to just maintain that sideways consolidation. It's super healthy. I mean, this bull market, as far as a sustainability standpoint, maybe people aren't as excited. People want the exponential overnight gains, right? But they don't understand that when you have that exponential overnight gains, the risk of the cycle ending or hitting a parabolic peak or a blow off top is increases. So the more you have these solid sideways consolidation periods, the more sustainable the bull run is, the more you can ultimately go higher or the bull market potentially extend. And my theory about the cycle is it's more driven by liquidity and momentum than anything. It's not the 4 year cycle, the mining. It's more psychology, momentum and liquidity. Yeah, I definitely am more of a believer in this cycle. We'll see. I think the biggest pullback we've had was from 108 to 75. Correct? I think it's around 30%, roughly speaking. So like that's a decent pullback. But we've consolidated now for a long time. I feel like we're in a really healthy position. A lot of the indicators have kind of cooled off, and I get more worried when Bitcoin goes up quickly. I'm the opposite. Most people get super excited when Bitcoin goes up quickly. I'm more like, oh shoot, calm down, like take it easy. Like I want the cycle to extend. I want sustainability, and I'm definitely the last thing I'll say is I'm definitely on the same page with Sina as far as there's good things that come with lower volatility. We're not going to have the same necessarily the same gains in the early days of Bitcoin, but we're also not going to see like he already said these 90% pullbacks.
By the way, thank you for saying about the holding thing. I had a couple of discussion on my pod lately, and I've been saying buying and holding is quote not enough. Because what if everyone would never sell from tomorrow? Well, then Bitcoin will become not interesting, not useful, right? My view is it's meant to be exchanged, right? Like. And that's my opinion, and maybe people have different opinion. It's great. I live in the Bitcoin standard, so if I don't spend it, how am I supposed to pay rent? I mean, how can I sustain my life? I don't have fiat under my name. If you have a job, if you live into the fiat standard, okay, fair. You use Bitcoin as a meaning of savings, right? You don't want to touch it, but at some point, when it can improve your lifestyle, you will sell some of it, and that's the argument, right? It's going to allow other people to join the network, and it's going to grow.
I completely agree. Sorry, Sina. I just want to say something really quick on this topic because I actually think this is a really interesting point. So people will say they'll regret selling Bitcoin or whatever. Well, I actually look at it very differently. So the only thing more scarce than Bitcoin is time, and the only thing more valuable than Bitcoin is time. And so from my perspective, if you can improve your life in a meaningful way, where you can improve the quality of experiences with your loved ones, there's nothing more valuable than that. So I think if anything, people regret not selling, taking some lifestyle chips off the table earlier to have that, like amazing experience of traveling or doing something with people they love or buying their dream house or, time is unknown scarcity. Bitcoin is known scarcity. We could die tomorrow. Time is the most valuable thing that exists. Time is unknown scarcity. Bitcoin is known scarcity. Bitcoin is not as valuable as time. So I actually think it makes logical sense, and you can make a logical argument that holding all your Bitcoin is actually not the logical thing to do. Selling some lifestyle chips to have those life experiences while still holding the majority of your Bitcoin and using something like the Quantile model, to take those chips off when you get value to have those experiences, you get to take advantage of the time and still hold your Bitcoin. So I think that to me is it's a philosophical thing, but I absolutely think time and experiences and change your life in a meaningful way is more important than Bitcoin.
I'm trading my Bitcoin for my freedom. I wake up every day, I do whatever I want, not what I have to. Those are things we have to discuss, because whenever you go on X and you see people with broken socks and no underwear and no chairs, oh, you don't sell your Bitcoin. That doesn't make sense to me. I don't know. I know, Sina, you wanted to jump in as well, but I don't know. What do you think?
No, I think you guys did a great job explaining all the aspects. I'll only add one sentence, which is if you're not selling Bitcoin, that means you don't have enough. If you're 100% in Bitcoin, then you have to spend it because life is about enjoying what you've saved. So that's the only thing I'll say on that.
I'm happy to share my screen if you want to talk about the Quantile model.
Yeah, so first off, what is a quantile model? This is a model that uses something called quantile regression. What is a quantile regression? If you guys are familiar with a regular regression, it's basically a line you figure out that perfectly goes through your data with minimum error. So of course, data is going to have a lot of noise up and down, but you want to find the best fit that hopefully would go through the middle of your data and have a reliable model of what's happening in the data. So essentially that line will allow you to eliminate the noise and focus on some systematic pattern over time if your data is amenable to that. Now, Quantile model extends this basic framework, and instead of just having a line that goes through the middle, it allows you to have lines that go through the bottom of a channel or top of the channel or any different quantile in the middle. And by quantile, for example, quantile 80 would mean you can have a line that covers 80% of the points below it and 20% above it. And then you can adjust that. So a quantile model would give you the ability to model the bottom, the middle, the 20% or 80%, whatever quantile you want in the data. And that's very important for us because we had this challenge in Bitcoin to, and not only we want to measure the average performance, but we also want to have a sense of the channel or the boundaries or how far Bitcoin can go up and down, which is really important as well. And that's what a Quantile model does. This is a fantastic graph, beautiful work by Plan C. This is really informative. A lot of people love this visualization, and we've put it on 21st Capital's Bitcoin Intelligence platform. You can access it online. Again, 21stcapital.com/BI. And here you can see that we've broken down the full probability space, which goes from quantile 1 all the way until 99 into different sections. And you can see that there is that blue region, like darker blue, that's the bottom of the bear markets. That's generally when, Bitcoin is, at the bottom of the bear market, and the model properly captures all cycles. Particularly in all cycles, we have traded down those levels. Then after the worst period is over, we get into the yellow region. That's, that yellow region is what we call the transition zone. That's when Bitcoin price goes from the first quantile all the way up to the 40th. And then from there to the 60th quantile, we have the transition zone. Bitcoin is warming up. We still don't have a parabolic move, but it's kind of warming up. And then after that point, after 60, which is very close to where we are actually very close right now to the 60th quantile, maybe 55 right now or something like that. After that point, we get into the red, pink and the red zone where actual parabolic moves are happening. This is when the main part of the bull market happens. And of course, because this is going to be parabolic and too fast, it will quickly exhaust. Like in a few months, it will exhaust itself and reaches the top of the channel. Maybe we don't exactly know, right? So it might go up to 90th quantile. It might go up to 99th quantile or something in that range. But this model does not necessarily tell us where exactly a bull market will end. However, it measures the risk. Like that quantile number you see on top of the on top right of the chart, top right 59.8 quantile. That basically is, that's a measurement of how far in the probability distribution we have progressed. So right now we've done 60% we are 60% of the way done, but 40% left. So that essentially tells us that quite a bit of growth is left in this cycle, right? We don't know if tomorrow we will go higher or a couple more months later, but from a long-term valuation, we see there's a lot more price action left. But now if in a few months we go up to the 90th quantile, I'm going to be saying, we have really progressed a lot in this cycle, and there is a high risk. We are in a high risk zone, right? High risk can go on for some time, but for a long run, for a long-term investor, you should know that the market is now overheated.
How did you come up with this, by the way? How did you develop this?
Yeah, so we did a lot of work on the power law model, a log version, and that again, it only gave us the average, and we were looking for something that allows us to expand. And I think pretty independently, Plan C and I, both separately, we came across the quantile regression. I used that previously in my research, and Plan C was also discovering it through his Bitcoin research. And then one day I tell him, hey, what about using this? And then he sends me a tweet for a few weeks back that he has actually talked about this. And we were like, okay, so both of us like this. Let's continue working on it. And then since then, we've done some more deeper work. We've done a lot of robustness checks, some more rigorous analysis on reliability of the model, out of sample tests, as you said, back testing. And every test we've done has just made us more convicted. But that doesn't mean this is perfect. There's always room for improvement. And there's a lot of great work that Plan C has also done on expanding and figuring out how can we even, add more richness to the model. But we have this base model. At the same time, we are doing more research on new ones.
I have $1 million question. Maybe I'll ask you, Plan C. So based on this model then, so two kind of part question. One, when are you expecting more or less the bull market to top, and how high do you think Bitcoin is going to go? No pressure there.
Yeah, no, it's no problem. I can answer that as best I can. So yeah, it's also to give you some context. So I've been actually full time studying Bitcoin and models and on chain data and everything to do with data related to Bitcoin for the last 5 years. So I've been fortunate enough to basically full time just research Bitcoin. And I just started sharing content on my X account and never expected to gain a following. I didn't intend to become a quote unquote influencer in Bitcoin, but it just kind of happened. A couple of years ago, and so um, I've definitely have looked at like a lot of stuff. Like I mean, I'm fortunate I have the top access to the best data with Glassnode, and I've looked at all sorts of models around TA and on chain, going back, like I said, the last 5 years. And when I came across the power curve, like the log, like looking at Bitcoin, log of price versus log of time since the Genesis block, that definitely, just looking at the pattern there, you could clearly see, okay, Bitcoin is following this like kind of adoption pattern related to, this power curve growth. Now, it was interesting when I kind of first came across it. Giovanni is the person that discovered it, or is kind of like the biggest voice behind it. When I first kind of came across his work, I just saw basically like an OLS regression, through the middle of the data set. And I said, okay, well, this is interesting. This shows the long-term pattern in a very, like you can see it follows this pattern. However, there was no way to identify anything on the top half of the data set. It was only kind of useful for the bottom half of the data set. And I looked at some websites that had the quote unquote power law, and some of their predictions for the price tops, like 2 standard deviations, and people were just taking the middle line, the OLS line, and basically just moving it up and saying, oh, this is the top band. There was no accounting for any kind of diminishing returns or decay functions or anything along those lines. So those top quantiles, it's a lot more difficult to model than the bottom 50%. I mean, I would say the bottom four. I have charts specifically we can look at on this. I can show exactly. I've done so much research on this. I've been obsessed with the Quantile model now for probably the last 6 months. I've been looking into it for the last year, but the last 6 months definitely been really doing a deep dive. And me and Sina have had lots of discussions. And the reason why I focus so much on the Quantile model is because there's like hundreds of indicators for Bitcoin. Right? You can look at all sorts of models, all sorts of charts. But it's very rare to find something that I've looked through it all, and I'm just like, no, this is really honestly the best thing I've come across in the last 5 years of full time looking at Bitcoin. As far as a long term model goes, and the quantile regression specifically is a breakthrough in modeling Bitcoin, and that's why I just am so excited about this model. So, anyways, to answer your question, when will we peak? I have no idea when we'll peak. That's the honest answer. I don't really, as far as the time frame, I'm cycle length agnostic. I'm focused on modeling as best I can the patterns of Bitcoin, and it's not like you just use the Quantile model. You have to be aware of the news. You have to have supplementary indicators. Like it's like, you have to be following liquidity. You have to be looking at, like, Sina's done some amazing work with all sorts. Like the thing I love about the platform that he has and we're working on is it's a very holistic perspective. So, it's not just looking at like, on-chain data. It's not just looking at, modeling Bitcoin through the best statistical regressions. He's looking at just the full spectrum, right? It's really, you really have to look at it all. So Bitcoin is a global asset, and there's just so much going on with it that you really have to be on top of it. So yeah, I like this as a base model, and then having supplementary indicators around it. So for me, it's more about where we are. I mean, it's figuring out those top quantiles, modeling them as best as possible, and then saying, okay, based on where we are, there's, historically speaking, we've only been higher than this point 5% of Bitcoin's history, or 3% of Bitcoin's history, or 1% of Bitcoin's history. And you can still hold when there's 1%, we're only in the top 1%, and you can say, well, we could keep going higher. But the reality is it becomes exponentially more risky that we're going to see some sort of a pullback, which is completely fine if you're a long-term holder, right? You can just hold through it all. If you're at a point where you haven't hit your targets, you just say, okay, I'm just going to hold. But at least you're prepared that there's probably going to be some sort of a pullback, and it just gives you a range. And then you just say, okay, well, this pattern keeps going, and I'll just wait another 5 years or whatever. So yeah, for me, I really have no idea when we'll peak. I'll be watching all sorts of indicators. I'll be seeing where we are based on the Quantile model, and if we're in that top range, personally, I'll take some lifestyle chips off the table and hold the majority of my Bitcoin and just keep going. So liquidity and things, I could definitely see the cycle extending. I'm open to that very much so. As far as targets go, this version of the Quantile model is based on linear quantile regressions, and it models the bottom 0 to 40. It models extremely well. But 40 to 99.9, it could follow this pattern. Like linear quantile regression, it does kind of have, like, it does account for the decay to a degree. The slopes of because it's using straight lines, so the slopes do diminish with those top quantiles. So it does model the decay to a degree. I would say my targets are a little bit less than this specific model, just with some of the work I've done. I think just modeling the decay of the peaks, I think it would probably be a little bit lower. But say we peak this year, anywhere between 180 to I think 260 is a completely reasonable price range for us to peak at. Anything over 300,000 this year, I'd be extremely surprised. I would be extremely surprised. And based on all the patterns through Bitcoin's history, I mean, unless the US dollar is breaking, unless like there's just like absurd news, like it would have to be, Bitcoin is becoming like the news, there would have to be a thesis or a solid news behind it to the point where I'm like, okay, even though we're at 300,000, we're in the top, 1% of the quantum model, I'm still going to hold, because this is nuts. Like something historic, like to 100 times more than anything we've had to date would have to happen for me to say, nope, everything's off the table at this point. So I think that that probability is low this cycle. And so, sorry for the long answer again, but basically, that's it. For me, it's not about the cycle length. It's about understanding where we are in the distribution more than anything.
Sina, would you agree with Plancy on the prediction?
Yeah, and we haven't really coordinated this, but my analysis, I have a slightly different quantile coloring, because we love to coordinate, but we also love to have some independent thoughts, so it ends up being additive when we meet and discuss. So I don't really expect 99.9 quantile to be happening. It's a little bit kind of the max possible. And when I look at the range from ADS above, I also get numbers from 180 to 280. That's kind of the range that I'm looking at. And again, in my opinion, the most honest way to think about topping is a range, because there's no way anybody's gonna get a specific number, even though people just like the very, very specific number. But that's kind of a recipe for disaster. But I have a range, and once we get to 180, I begin thinking about, okay, we have achieved fantastic success. The thesis has played out, but at 180, you are looking at a $3-4 trillion asset, and for that to also double, you need another $4 trillion of money. Where is that going to come from, right? So we need time, So when two things can happen: either we have some sort of a quick correction like the last cycles, or it can also the cycle pattern might change, and we actually get a slow bleed. 50% correction, 40% correction, for example, but over like 2 years, slow, step by step. And then by the time we are done, we might actually not be too far from where we started, because new demand also comes in. That can happen. But nevertheless, for me, if we get into 180 and more, I'll probably do some strategic moves. Could be like not stopping buying. Like I have a DCA plan that's going, I might stop it. Or if I have an expense in life, I will not hesitate to sell a little bit and trim my position a bit here and there, because at most of the times I'm pretty much all invested. I hate to see cash anywhere, so I keep just a little bit for like immediate expenses, but mostly, especially when we are in a bull market, I don't want to be, diversifying at all. So, but at 180, would be a place where I will take a step back and just let the market play. If it goes higher, the majority of my stack is still there. That's fantastic. If it doesn't, I have saved some of. I've made some good decisions at those numbers. So, and then if we from 180 we go to 250, we go to 280. At that point, I'm like, very unlikely that we can keep going. So, do with that information whatever you may.
I think the 150 is going to be very attractive to many people, right? Potentially even 120, I will argue. Some people are going to start actioning DCA, maybe like 5%, 8%, 10%, and start slowly to sell out. And also, like Plan C said, I would be very interested in see how rapid the move will be. This is going to indicate something. As you highlighted here in the chart, we are still missing, technically, if history is any repeats, we should see a parabolic phase, right? Which is when maybe retail is going to come in or whatever happens. If you think long term, Trump, strategic reserve, who won the presidency, it doesn't actually matter in 10 years from now. It only impacts the smaller time frame.
DCA, of course, most people are probably familiar with that. But now you can use Bitcoin Quantile Model to make your DCA intelligent, right? So if the quantiles are lower, you might want to gradually adding. For example, like at 80, 75, if you were following our feed or our reports on the platform, we were constantly telling people this is a fantastic place to buy. I myself made my biggest bet at 78 or 77. I didn't get the bottom. The bottom was a little bit lower than that, but it was around the right places. I can't really expect more than that. And that worked well. I was also looking at the Quantile model. The Quantile was much lower. We had a good reset. We were also looking at macro and on-chain data. So that allowed me to make a better decision. But if we go higher, like at 150, 180, you can do the reverse. You can do DCA out, right? So you take a little bit, just a little bit, and then if you go higher, you take a bit, you trim a little bit more, and if you go really high, you trim a lot. And if you go back down, you just enter the market again. And the good thing about the Quantile model is if we go up slowly, the risk score, which is the same as the Quantile, right? The risk score doesn't go up because, it has its own progression, right? If you go up as fast as the model says, risk doesn't go up. But if you go too much faster than the recent trend, then the risk increases, right? And we are quantifying the risk. And of course, if the risk is at 80%, you should be, not financial advice, but you should be thinking about the possibility of some volatility. And if you go to like 90%, I would be very worried about that, right? And then there's many ways you can play. Like I said, DCAing out is great. Saving some of your profit for your life expenses is always a good idea. And then you can also, if you have the experience and if you know what you're doing, you can also use the variety of financial instruments that are available. You can, for example, sell call options or do covered calls that allow you to, sell even higher. Like at 200,000, you can sell the upside from 300, and if it gets to 300, fantastic, you'll be happy. If it doesn't get, you collect the premium. So there are many ways you can play. But the idea is now you at least have more knowledge than just a coin flip about where we are in a cycle.
Yeah, super well said. And by the way, I will link in the description, of course, the 21 First Capital website where you can find also this beautiful interactive model here, which you can play with. Also, you had Plan C, you had some charts. Do you want me to pull them out and discuss those too?
Yeah, we'll go through those super quick. We won't spend a ton of time on them. This was just kind of some research I've been doing as far as modeling the top quantiles potentially better. I mean, I do think the original version of the quantile model is completely valid and it could completely play out that way for the upper quantiles. We don't know. This is just alternative kind of modeling and the reason why is because if you do linear quantile regressions and you're doing it in log space, you get straight lines. And so what I looked at all the slopes across every quantile, and I noticed that the bottom about 40 to 50% of the quantiles were basically all the same slopes. But then once you get past 40, the slopes start to go down. So, and what that means is potentially a linear fit is not the most ideal fit for the top quantiles. So I started looking to nonlinear fits and decay functions. And a decay function, essentially, over time, and you can see it just visually right here, you can see that these are called residuals. So what residuals are, and Sina can explain this probably technically better than I can. I'll do my best, but essentially what I did here is I took a 0.4 a quantile regression. So what that means is I drew a line through the data set where 40% of the data points fell below, 60% of the data points fell above. And the nice thing about quantile regressions is it's a robust fit. So it's actually it finds the best fit, but it's not as sensitive to outliers. So it's a very stable fit. And so I use that as the baseline. And then that's the zero line. So if you look through this chart, where it goes across at zero, that's where I did the 0.4 quantile regression. And then so what I did is I looked at the deviations above that, and you can see clearly the deviations above at each peak are not as extreme. And so you can model this using what's called a exponential decay function. There's all sorts of decay functions you can use, but this one specifically is called exponential decay function. And you can see that so far we follow this pattern. Now it's 4 cycles. It's 4 data points. You could say, could it break? Absolutely, it could break. But is it a very clear pattern we have to take note of? 100%. And so, it matches theses. It matches the volatility coming down. It matches a higher market cap is harder to move. It matches, a more stable network, a more stable asset class over time as there's more people joining, as there's more money coming in, as there's more adoption, as there's more players entering the space. So it aligns with what we would see in a network, a financial asset that is gaining adoption. And so I believe that and also I should mention quickly. This wasn't updated recently, so we're higher. If you look at the pattern on the chart, we've had a significant move since then. So we'd be a little bit higher here. So, but when we say we're at the 60th quantile, I just want to make it clear that doesn't mean when we say 40%, it doesn't mean there's going to be an exact 40% more upside. The gains with the upper quantiles, because Bitcoin goes exponential, the difference between say 90 to 99 is way more significant than the difference between say 40 to 50 or 50 to 60. So the actual distance or the actual amount in dollar terms, as you go to the upper quantiles, it's a bigger difference. So even though we're at 60, there's still tons of upside. These models are showing there's tons of upside left, but it does show that there is a decay pattern, and that's what I'm focused on modeling here. So in a newer version we're going to release, some of the targets might be just slightly lower, and that's just accounting for this this nonlinear pattern with the upper quantiles. That's pretty much it. And the bottom stable, you can see it straight across on the bottom. That's that solid base, and then you can see there, the volatility is coming down a bit, and that's basically the pattern of Bitcoin. I mean, yeah, I can show maybe the other chart we can talk about quickly, and then that'll add some more color. So yeah, this is like nerd. this is nerding out pretty extreme. So what I did here is I basically I took the full data set, hourly data, 130,000 data points since the beginning of Bitcoin. Since 2010 is when we have, with Glassnode, 2010, July 17th is what it goes back to. So I took the full data set and I said, I'm going to remove 5 years of data. So I removed 5 years. And then what I did is I added back in 30 days of the data. And I ran a quadratic, it's called a quadratic quantile regression. And then I added in another 30 days, ran another quadratic quantile regression. I did this all the way until you fill the data set back to where it is today. I did that with 30 days, 90 days, and 10 days. And then I normalized it all with each one. And so it's 17,000 quadratic quantile regressions, I believe. And what this shows is essentially over the last 5 years, it shows which quantiles have followed a linear quantile regression the best. And the reason why is because a quadratic, and again, Sina can help me explain this, but a quadratic quantile regression, it can fit a straight line, but it can also show some curvature. So basically across all the quantiles, we can actually see what's the pattern it follows best. Does it follow a straight line best, or does it follow a bit of a curve? And we can see to what degree of a curvature. So a quadratic quantile regression has what's called a quadratic coefficient, and you can see the degree of the term and basically assess curvature. So as you can see on the chart here, and this is the last 5 years. So it's not just, I also have a snapshot of today, but I wanted to assess basically the last 5 years, which quantiles have followed, because this is reliability. I mean, 5 years is more than a cycle so far. So I wanted to take a good amount of data, and basically show that certain quantiles have been very, very stable. You can see there's a clear pattern here. So as you can see, up to about 40, there's the best fit is a straight, basically a linear quantile regression, and that's what we've been speaking to. And you can see the drop off, and it becomes more nonlinear. And the best fit, is more likely to be a decay function. So that's basically what this shows. Higher bars equals more linearity, and basically, this is a lot of regressions, and this is really breaking down quantile by quantile, mathematically what the best fits have been over the last 5 years in a sustainable way. And I do believe, basically this just shows, and I don't think anyone else has done this level of analysis on it, but basically we can say, around the I'm trying to find the most stable quantile to basically create a base. And then from there, I'll look at the residuals, which is what the last chart was. And then I'm going to fit decay functions, basically to the top residuals, which will help to map those higher quantiles. So sorry for all the lingo and the nerd stuff, but it just the takeaway here is that Bitcoin has kind of two regimes. One is it follows more of a stable, consistent long-term pattern of growth. And on top of that, there's this kind of volatile, exponential growth, chaotic period where we go through the cycle, the parabolic peaks and come back down. So yeah, that's it. I don't know if Sina wants to add anything, but that kind of, hopefully the visual will help people see. I basically ran those 17,000 regressions.
I love this. And by the way, to put the cherry on the cake and my 2 Satoshis, if we do indeed go to the 180 or 200,000-ish and we correct 60%, well, guess what? We end up where the ETF has started, more or less. Well, all those companies, they enter the ETF, they don't want to see their price of entry being broken.
I think you mentioned a fantastic point, and if you want to take it to the next level, you can accurately track the cost basis of ETFs and other players, and it's actually something we use in our analysis too. Like, cost basis is very important. Like, it's very likely that when price goes back down, and it's very helpful. I can tell you it's very informative for understanding where we're going.
Yeah, I mean, thank you both for doing this incredible work. Guys, as always, in the description down below, you will find both Sina and Plan C Twitter accounts and all the links. Please make sure to go and check them out because they're doing a lot of work.
Yes, fantastic. Thanks a lot. Appreciate it. And follow Plan C and Maurizio. Every time we have one of these episodes, it's so much fun. Thank you very much for inviting us.
It's been a pleasure. Yeah, and guys, thank you so much for watching, and we'll see you guys on the next one.